Hey guys, what's up? I'm Erin and welcome back to the channel. The one big, beautiful tax bill that's making headlines. What if it passes? What does that mean for you? Will it save you money? Will you end up paying more? Will your paycheck go further? Or are you going to be picking up the tab for someone else? Let's take a look. I'll walk through exactly how it would affect Americans at every income level with real examples so you can see where you land. And while there are a lot of headline-friendly wins here, it's important to ask the other questions like, how are we paying for this? Who's getting a temporary boost and who's locking in permanent perks? And what are the broader impacts? This bill is structured to deliver benefits across income levels. The type and the length of the benefit really depend on your situation. So let's walk through 3 different income brackets and then also a bonus example of a situation where there's no benefit. First up, a lower to a modest income earner. If you earn wages, especially hourly wages, this bill really does throw in some tax benefits. There is no taxes on overtime. So if you're under a certain income threshold, any overtime you do would not be subject to taxes. So you would get to keep more of that in your pocket. The proposal also includes no taxes on tips, which is a really big deal for service industry workers.
And one of this is no tax on tips.
As long as you're under certain income thresholds, those tips become tax-free. The standard deduction gets locked in at a higher rate and gets an extra boost through 2028, and non-itemizers can deduct charitable contributions up to $150. Let's look at an example. Let's say you're a single person earning $40,000 a year and you have no kids. Today, your standard deduction is $15,000. This bill gives you a $1,000 bump, so you can now deduct $16,000, lowering your taxable income and saving around $120. If you work overtime or earn tips, this income might be entirely tax-free. Add in retirement contributions or a charitable donation, and your savings increase even more. So we could estimate that the annual tax savings for someone in this tax bracket might be $250 to say $800 per year, depending on your job and how much you contribute or donate. Next up, we have middle-class families with children. This is the group that receives the most immediate tax benefit, but it's also one of the most temporary packages. The child tax credit, which is currently $2,000 per child, would get a bump to $2,500 per child, but only from the years 2025 through 2028. Also, the standard deduction gets a bump. Currently, it's $30,000 for a married couple filing jointly. It would get a bump to $32,000. But remember, this standard deduction bump is only temporary, from 2025 through 2028. This group would also have the option to open a MEGA account, which is a new investment option for children and minors, which you could use these funds for college or a business or even buying their first home down the road. I do have a full video on it, and if you're curious, I will link it above and down below. Also, if this group does work overtime or gets any tips, again, they would see a bump here as these would not be subject to tax. And there is an extra line item saying that car loan interest might be deductible. So let's run an example here. Let's say we have a married couple with 2 kids earning $85,000 a year. Their standard deduction jumps from $30,000 to $32,000, saving them around $240 for the year. The child tax credit also increases from $4,000 to $5,000. If either parent works overtime, that income isn't taxed, and they can also open a MEGA account for each child that will grow in a tax-advantaged manner. So their estimated annual tax savings would be about $3,500 to $6,000, depending on overtime, deductions, and child-related savings. Next up, let's consider high-income earners, especially business owners. This is the group that sees the most enduring changes with permanent benefits for income planning and wealth transfer. First and foremost, qualified business income QBI deduction increases from 20% to 23% and is made permanent. The estate tax exemption jumps to $30 million for married couples. The alternative tax relief gets locked in and made permanent, payment. And again, for those married and filing jointly, they still see that $2,000 bump to the standard deduction. Let's run through an example. Let's say we have a married couple who earns $200,000 a year, with one spouse owning a business. Their QBI deduction increases to 23%, reducing their taxable income significantly. The standard deduction bump adds another $480 in savings. They qualify for the enhanced child tax credit, and the $30 million estate exemption helps with long-term wealth planning. Their estimated annual tax savings could be anywhere from $6,000 to over $12,000, depending on their structure and planning strategy. But what group might see no benefit whatsoever? It's not all upside. Some Americans will see little to no change whatsoever. Let's say we have a single person earning $22,000 a year as a part-time worker with no kids. They already pay little or no federal income taxes. They don't earn tips or work overtime. They don't contribute to retirement. They don't make charitable contributions, and they're not eligible for mega accounts or child tax credits. Their estimated annual benefit is $0. They're left out of most provisions because their income is already below the taxable threshold, and they don't engage in the types of activities that this bill rewards. Let's look at tax changes by category. Let's zoom out and see how this bill distributes benefits. Business owners walk away with some of the biggest, most permanent perks, like a higher QBI deduction, expanded estate exemption, and bonus depreciation. Wage earners benefit from tax-free overtime and tips, a higher standard deduction, and the Savers Credit. Parents get a bump in child tax credit and new tools like mega accounts, though most of those benefits are only temporary. Seniors earning less than $75,000 a year get a brand new $4,000 bonus deduction, and low-income earners may qualify for modest credits and exclusions, but it depends on their situation. And when we consider investors and estate planners, they gain long-term tax tools, even though some clean energy breaks get rolled back. So yes, everyone gets something on paper, but not everyone sees a dollar benefit, and some of the benefits do fade fast. Who gets the most lasting benefits? Not all of the tax breaks are built to last. Some of the provisions expire as soon as 2028, while others are made permanent. High income earners and business owners hands down walk away with the most enduring benefits. They get a QBI boost, they get the estate tax expansion, and the alternative minimum tax is locked in. When it comes to middle income families, they get to enjoy meaningful savings, but most of those benefits sunset after 2028. And modest earners, they may see tax relief too, especially if they earn overtime or tips, but those provisions are set to expire after 2028. So unless they take advantage of mega accounts or the Savers Credit, many of their benefits would expire. And this creates a very real imbalance. It's not inherently wrong, but it does raise questions of fairness. If you're a middle income earner, you might see tax savings for a few years. But if you're a business owner or in estate planning, you might lock in forever benefits. So here's a quick snapshot of how it breaks down. High earners and business owners see major long-term gains that are locked in. When it comes to middle income families and modest income workers, they're seeing more temporary and limited benefits. Let's look at the big picture critically and be honest for a minute. There are tax cuts in here for nearly every American, but importantly, there are no significant cuts to offset them, which means we're going to be putting a greater pressure on the national debt, and that is absolutely something we should be talking about because that is something future American taxpayers will have to deal with. Also, some of the repealed credits like clean energy incentives, manufacturing credits, and university exemptions may hurt certain sectors, depending on your industry or your values. And while the bill does simplify things in some areas, it does add a lot of complexities. There's new income phase outs, new rules, mega account qualifications, and absolutely something that we have to pay attention to, the expiration of a lot of these tax benefits. And let's be real, this bill does reflect a political philosophy. If you believe in smaller government and less taxes, many of the things in this bill will appeal to you. However, if you believe in stronger public funding and progressive taxation, much of what you see in this bill is going to feel like it leans towards the wealthy. Neither of these views are wrong, but it's important to recognize that how you feel about this bill might be just as much about your values as it is about your income. The bottom line is, if this bill passes, it's going to shift how Americans experience taxes. Families with kids, they're the biggest short-term winners. Business owners, they're the biggest long-term winners. Modest income earners, they get some relief if they qualify. High net worth individuals, they see the most lasting structural benefit. Will it pass as written? Well, that's a question for Congress, but you already know what's in it, so you're ahead of the game. What are your thoughts? Share them in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. When it comes to the child tax credit, that goes from I can't say expanded estate. I don't know why those are a tongue twister. However, if you believe in a stronger, business and smaller government. Fire truck.